Ever wondered how your money grows when you invest it, or how banks function to facilitate our daily transactions? Imagine a world where these systems are not as seamless as they are today. Intriguing, right? Our journey today ventures into the heart of the financial market, exploring its functions, the banking systems, and the world of securities. So, are you ready to dive into this complex yet fascinating world? Stay tuned as we unravel the mysteries of the financial market. The financial market is not just a place where buyers and sellers meet, it's the nerve center of our economy. So, what does this nerve center do? Let's dive into the key functions of the financial market. First up, the financial market plays a vital role in the mobilization of savings. Imagine you have some cash stashed away. Now, you could keep it under your mattress, but that won't do you much good. Instead, you can invest that money in the financial market. Your savings become capital for businesses that need funds to grow, creating a win-win situation. You earn returns on your investment, and businesses get the capital they need to expand. Next, the financial market helps in the determination of price. Think of it as an auction house. The prices of securities are determined by supply and demand. If a lot of people want to buy a particular stock, its price will go up. If more people want to sell than buy, the price will fall. This process of price determination helps allocate resources efficiently in the economy. The financial market also plays a crucial role in risk sharing. By allowing the transfer of risk from those who undertake investments to those who provide funds for those investments, the financial market helps spread risk and reduces the impact of a potential loss. Improving liquidity is another key function of the financial market. It allows you to convert your investments into cash quickly and without significant loss in value. So if you suddenly need funds for an emergency, you can sell your investments without much hassle. Lastly, the financial market provides information. It's like a giant billboard that's constantly updated with the latest financial news. This information helps investors make informed decisions about where to put their money. In a nutshell, the financial market is the engine that propels our economy, enabling businesses to grow and individuals to achieve their financial goals. Banks are more than just places to keep our money safe. They are crucial cogs in the wheel of our financial system. Now, let's delve into the fascinating world of banking systems. To understand this vast machinery, we need to primarily focus on two types of banks: commercial banks and central banks. Commercial banks are what most of us interact with in our daily lives. These are institutions where we deposit our money, take out loans, and conduct various financial transactions. When you open a checking or a savings account, or when you apply for a mortgage or a credit card, you're interacting with a commercial bank. But these banks do more than just house our money and loan it out. They act as intermediaries, facilitating the flow of money from those who have it to spare to those who need it. On the other hand, central banks are a different beast altogether. They're like the puppeteers of the financial market. Central banks are responsible for managing a nation's currency, controlling interest rates, and ensuring the stability and integrity of the financial system. They don't deal directly with consumers like you and me. Instead, they deal with commercial banks and the government. So how do these two types of banks interact? Well, central banks influence the operations of commercial banks in several ways. For instance, by changing the interest rates, they control how much it costs for commercial banks to borrow money. When central banks lower the interest rates, it becomes cheaper for commercial banks to borrow, which in turn allows them to lower the interest rates for their own customers. This encourages more borrowing and spending, stimulating economic activity. On the flip side, when central banks raise the interest rates, borrowing becomes more expensive. This slows down spending and helps to cool off an overheated economy. It's a delicate balancing act, and central banks have to be careful not to tip the scales too far in either direction. They are the guardians of financial stability, working to prevent economic bubbles and crashes. In a nutshell, commercial banks and central banks are like two sides of the same coin. They perform different roles, but they both serve essential functions in the financial system. Commercial banks connect individuals and businesses, facilitating transactions and providing credit. Central banks, meanwhile, keep an eye on the big picture, managing the economy on a macro level. So the next time you walk into a bank or use your credit card, remember that you're not just conducting a financial transaction. You're a part of a vast, intricate system that keeps our economy running smoothly. Whether it's buying a cup of coffee or stabilizing our economy, banks play an integral role in our daily lives and the broader financial market. Securities are the tickets to the financial market's grand show. Now you might be wondering, what exactly are these securities? Well, they are financial instruments that hold monetary value. They represent an ownership position in a publicly traded corporation via stock, a creditor relationship with a governmental body, or a corporation represented by owning their bond, or rights to ownership as represented by an option. Let's break it down further. The first type of security that comes to mind for most people is stocks. When you buy a stock, you're buying a small piece of ownership in a company. This gives you the right to a portion of the company's assets and earnings. Stocks are often the go-to choice for investors looking for significant growth, but they also come with higher risk compared to other securities. Next, we have bonds. Think of bonds as loans, but you're the lender. When you buy a bond, you're essentially loaning your money to the organization that issued the bond. In return, they agree to give you interest payments at regular intervals and to return the face value of the loan at its maturity. Bonds are generally considered safer than stocks, but they offer lower potential returns. Then we have derivatives. These are a bit more complex. Derivatives are financial contracts that derive their value from an underlying asset. These assets could be stocks, bonds, commodities, currencies, interest rates, or market indexes. Derivatives are primarily used for hedging risk or for speculation. They can be a great tool for advanced investors, but they can also be incredibly risky. Now, how do these securities contribute to the functioning of the financial market? Well, they serve as the primary means of raising capital. Companies issue stocks to raise money for expansion, product development, or other projects. Governments issue bonds to fund public projects and services. And derivatives help investors manage risk and speculate on future price movements. But it's not just about the issuers. Securities also provide benefits to investors. They offer a way for individuals and institutions to grow their wealth. By investing in securities, you're not just putting your money in a safe, you're giving it the potential to grow. And that growth isn't just good for you, it's good for the economy as a whole. When companies get the capital they need to grow, and governments get the funding they need to provide public services, it can lead to job creation, increased consumer spending, and overall economic development. In essence, securities are the lifeblood of the financial market. They facilitate the flow of capital, allow for risk management, and provide opportunities for growth. They're more than just tickets to the financial market's grand show. They're the very building blocks of investment. Securities offer individuals and institutions the opportunity to grow their wealth and contribute to economic development. So we've taken a journey through the financial market, explored the banking systems, and learned about securities. Let's take a moment to reflect on what we've discovered. We started with the financial market, the grand stage where money meets opportunity. We learned that its primary roles are to facilitate savings, allocate capital, and manage risks. This market is like the circulatory system of our economy, pumping life into various sectors and industries. Next, we delved into the banking systems. We've seen the important roles commercial and central banks play. Commercial banks are like our personal financial partners, helping us save, borrow, and transact. Meanwhile, central banks are the guardians of our economy, regulating money supply, controlling inflation, and ensuring financial stability. Then we navigated the complex world of securities. We learned about the various types of securities, from stocks and bonds to derivatives, each serving a unique purpose in the investment landscape. They're the tools that allow us to participate in the financial market, to grow our wealth, and to contribute to the economy. In essence, these three components, the financial market, the banking systems, and the securities, are like the gears of a well-oiled machine, each playing a vital part in maintaining the smooth operation of our financial world. Next time you make a bank transaction or consider an investment, remember the intricate system working behind the scenes to make it all possible.